There you go. All right, here we go. You're live.
Good afternoon. I'm John T. Reed. This is my son, Dan Reed, my oldest three. Today I'm going to talk about this new edition that came out. This is the 20th edition of Aggressive Tax Avoidance for Real Estate Investors. Over 100,000 copies sold. Came out first in 1981 on August 13th, which happened to be the day that the Economic Recovery Tax Act of 1981 was signed by Ronald Reagan. And that rendered this book, first edition, obsolete the day it came out. No worries, it sold out in 60 days, and I made a second edition, which included the Accelerated Cost Recovery Act of 1980, the Accelerated Cost Recovery Depreciation System. Let me tell you what the big picture ideas of this book. I've had a lot of people, because the title,
Aggressive. Bring in Facebook here in a second. So.
Because of the title of Aggressive Tax Avoidance, a lot of people think it's shady or crooked or going to get them in trouble. No, it's not. Matter of fact, I got audited once in my life after the book was out many years, and it was a TCMP audit. That stands for Taxpayer Compliance Management Program. That is the audit where they audit every line on your return. Every place where you made an entry, they say prove it. Like you say you're married here, prove it. Marriage certificate. You say you got 3 kids, let's see the birth certificates. So I went through that audit. I had a 23-page return that year. I did tax-free exchange out of one property into 2 others that year. A whole lot of stuff. And I got a letter of commendation. Here it is. You can't read it from the TV, but it's in the book, page 30. Letter of commendation from the IRS because it was a no-change audit. 23 pages, including all kind of aggressive tax avoidance stuff. No change. And I actually got a refund. We waited until the statute of limitations ran out for the IRS. And then I filed an amended return because we had come across some stuff in the audit, which took 3 days. We had come across some stuff that was in my favor.
So even though you're actively telling them I'm engaging in aggressive tax avoidance, the IRS still praised.
They gave me a letter of commendation.
Right.
Letter of commendation. Because it was a no change audit. 23 pages where every single line was scrutinized. It proved that. And I did. So this aggressive tax avoidance is not illegal stuff or shady stuff or any of that. Now,
unlike some tax advice out there.
Well, let's get specific. Right. Rich Dad, Poor Dad, his book was co-written by a CPA. Robert Kiyosaki wrote that. And he said in there that if you incorporate, you can take vacations in Hawaii and deduct them. That's a damn lie. You can't do any such thing. And first off, incorporation has 0 meaning when it comes to deducting business expenses. Sole proprietor, which means you don't have any LLC or corporation or any of that. Sole proprietor can deduct, quote, ordinary and necessary business expenses. So I think it's section 163 of the Internal Revenue Code. And but you can't deduct a vacation. Doesn't matter whether you're a corporation, an LLC, a sole proprietor, a priest, nothing. Nobody can deduct a vacation. It's not an ordinary and necessary business expense. Furthermore, if you have a corporation, and he says you're in Alabama or something, you hold your board meeting in Hawaii. That's not ordinary and necessary for a corporation in Alabama to go all the way to Hawaii to have a board meeting. It might be appropriate for a trade association to go to Hawaii because they want people to come to the convention and they want an attractive destination, but not for you and your wife to claim you had to go to Hawaii to have a board meeting for your Alabama closely held corporation. So it's a damn lie what he said. And he had a CPA co-author. So anyway, there are 8 reasons why real estate investors pay too much tax. One is their ignorance of parts of the tax law that would help them. Second is bad advice from tax advisors, some of whom are trying to make their job simple, not make your taxes low. Inordinate fear of the IRS and the courts. And I have chapters in here about fighting the IRS and how it works and where you go and which court to pick and all that stuff, which takes some of the fear out because it'll become familiar to you. Erroneous or out-of-date notions about losses or tax shelter and that kind of stuff. Lack of understanding of the judgmental nature of many aspects of the tax law. For example, when you buy a building, you can only depreciate the structure. You can't depreciate the raw land underneath of it. So you have to say which percentage of the overall purchase price goes to the structure. You want that to be as high as possible. So I talk in here about how to get that as high as possible without triggering a penalty. The lack of understanding of the time value of money. And that is, when it comes to paying taxes, later is better than sooner. And there are a number of things that you can do that delay paying taxes. The time value of money is the idea that it's better to pay later than sooner. Now, it's not so wonderful now with interest rates at 1 or 2% as it was back when I was in business school, and the interest rates were like 15. And right after business school, the interest rates, mortgage interest rate got up to 18%.
Perhaps some listeners aren't as familiar with the time value of money.
Time value of money is
quick explanation.
It's if you can hold money and not pay it to the IRS until 10 years from now, you can put it somewhere and make interest on it, or you can invest it in real estate and make real estate profits on it. So the time value of money just says it's better to receive money now than later. It has more value now than it will later. Partly that's inflation, but partly it's just an opportunity cost of having money not in your pocket anymore. And it's time value of money says it's better to pay later than sooner, and it's better to receive sooner than later. That's the basic idea of it. It's a mathematical calculation. If you have a financial calculator or a computer, you can do time value of money, and you'll get little helpful fill in the blanks, and it'll spit out the answer things. Human inertia, reluctance to change the way you do things. And the eighth one is failure to think through the old wives' tales of tax law. One of those is the, you never claim a home office because it's a red flag and they'll audit you. BS. I've been claiming a home office since the beginning of time. I got audited the one time, and they claimed that I was selected at random for the Taxpayer Compliance Measurement Program audit, where they randomly check the hell out of some people to see where people are cheating. So I was only audited once. I've been claiming a home office year after year. You are entitled to it. It's in the law. It's not, I didn't sneak into the Congress and write it in one day. It's a law that you're allowed to deduct a home office.
Yeah, I've been deducting a home office for less time, but over a decade, and never had an issue.
Well, and even if you do, if the IRS says they're going to audit you on your home office, I say, okay, what's your problem? I use it exclusively for that
audit's
purpose.
A pain in the ass, but if you did your taxes right,
well,
you don't have a lot to worry about.
You're entitled to it. You're entitled to it. The law says you can. The law doesn't say, well, okay, but you better not. That's just the old wives' tale nonsense. I have a whole chapter on the home office in here, so you're going to know better than the auditor what the home office rules are after you read that chapter. The lady who audited me, she saw my inventory in the audit. I'm a publisher of real estate books and so forth, and when you're a manufacturer or publisher, you have what's called a cost of goods sold, part of calculating your business income. And the cost of goods sold is partly what was your inventory of books at the beginning of the year, what was it at the end of the year, and how many did you add to it, and then they figure out how many you sold, and that's the cost of goods sold. So she looked at my inventory where all the book titles are abbreviated, and the first one in alphabetical order was ATA. And the IRS auditor says to me, "What's ATA?" And I said, "Gulp, aggressive tax avoidance." She said, "Can I see that?" I went there 3 times. I said, "Next time I come, I'll bring you one." So I brought her one of these, 1988. And then the next time I came, she had read it cover to cover. She said, "Thank you for the book. I learned a lot." This IRS auditor, full-time, 24/7. That's what she does. Anyway, so how is my book going to fix these 8 problems I listed? Number one, I'm going to tell you about the tax breaks that a lot of investors overlook. One that I had, and it was in the audit, the return was audited. I was ordering forms. Years ago, the TurboTax didn't have the forms in it, or not all of them. Anyway, I was ordering forms from the IRS because you order them like in November, they send them to you for free. And one of them was called Credit for Prior Year Alternative Minimum Tax. And I said to myself, what's that? But it's free. And the forms come with instructions to fill them out. I don't know, I'll get that. So it arrived and I looked at it and I said, damn, I'm going to get $8,000 refund from this. So I double checked it with a tax expert. He said, yeah, but he hadn't heard of it until I told him about it. And then I put it in my newsletter, and one of my readers also got an $8,000 tax refund from it. So I tell you about stuff that people have written. The IRS auditor, she said, I never heard of that. And then when she came back the next audit, she had checked with her boss. She said, it's correct. $8,000.
What's that for?
Credit for prior year AMT. If there ever comes a year when you pay the alternative minimum tax, and then in a subsequent year, you don't, you get back the money you paid before.
Right.
Nobody knows about that. And I didn't know about it. I looked at the instructions on the form and said, Jesus, that means I get a lot of money. And I did. I got a check. I'm going to put the check in the newsletter article I wrote. Say, see?
How does someone end up paying AMT? Is there a short summary?
Well, once upon a time.
I've been filing my taxes, and it asks me the question. I never qualify. So,
well, rub it in. I do. Once upon a time, somebody found that 155 people did not pay any taxes for the year. And everybody went nuts. And they looked up, how did they do that? And then they just screwed around. They created it, basically had to do a second tax return where they take the things that those guys use to reduce their tax to zero, and they take them away from you above certain thresholds and all. But so the alternative minimum tax is just a way to prevent those 155 people from not paying any taxes. But because of lack of indexing, the number of people who get hit by the AMT went from 155 to like 5 million. It was a scam by the Congress. You know, once they got it in, it was like the blob taking over the world. Anyway, that credit for prior year AMT, people would call me and say, I see this in your book, and I took it to my accountant. He said he never heard of it. And I said, well, in the book, I give the citations of the regulations and all that, the form number. And he said, yeah, I showed that to the accountant, and he looked it up. He said, I'll be damned, Mr. Reed is right. So anyway, number 2, it shows you how to tell when you're getting bad advice and how to find a good tax advisor. There are a ton of you people who have a CPA, and when the subject of tax comes, I don't worry about that. I don't understand. I have my CPA takes care of all that. Forget that crap. Read this book and then go look at your last year tax return and see whether or not your CPA is worth a damn. See whether or not your CPA was screwing you for the last 20 years because you are militantly ignorant about the tax law. And it's like beneath you. You have people that you read the book, you see if your guy's doing it right. And I deliver this is a book for laymen, but it has all the citations. Lawyers and tax and accountants practice out of this book because I have all the citations, regulations, letter rulings, court decisions, all of them. So when you go to this guy says I can do such a, I never heard that before. Well, he says this court decision says it. Oh, let me look that up. Son of a bitch, he's right. Number 3, this gives you a more accurate picture of the IRS and the courts, so you fear them less. They're auditing, I think this year, 0.2% of tax returns. That means you have a 0.2% chance that they're going to audit yours. So you shouldn't be pussyfooting around, not claiming a home office because you're afraid of the 0.2%. It's a tiny little number. Correct your erroneous ideas about taxes. Explain the judgmental nature of many taxes and how you can be aggressive with those. Time, value, money. I explain how to do that in the book. And how to overcome the there's 2 parts to tax avoidance. Number 1 is you need to know all the laws that you can use. And an amazing number of people, including CPAs, don't know them. I just gave you the example of the credit for prior year AMT. You have bonus depreciation, first year expensing, all sorts of stuff that a whole lot of people, including CPAs, often don't know about. Number 2, the second thing about aggressive tax avoidance is the judgmental areas. You want to go as far as you can in your favor. one of the things that came out in the campaign about the way Trump was talking, I said in the book, and I said when I was discussing the Trump campaign, this guy's a negotiator. And I said, you should think of your tax return as your first offer in a potential negotiation with the IRS. You put on the tax return your first offer. Now, maybe when you get into an audit, you and the auditor go back and forth and you compromise somewhere in between. But don't compromise before the audit. Put in the tax return your first offer in a potential negotiation. And 99.8% of the time, there is no audit. So you get to keep your first offer in a potential negotiation.
Are there any issues with having the wrong return in this negotiation? Penalties, etc.? Underpayment penalties?
Yeah, I discussed that at great length. If you have a deficiency, which means you didn't pay enough, you were supposed to pay X, you pay less than X, that's called a deficiency. I have no problem with you having a deficiency. My book tells you to do stuff that may result in you having a deficiency. If you have a deficiency, you have to pay the tax plus interest, which is a statutory rate. It's published constantly according to the current market. So you have to pay the tax and interest. So you got a loan from the government with a moderate interest rate. Big deal. Now, he used the word penalty. My book is against you having to pay a penalty. So penalties mean you were a bad boy. So my book says, don't worry about deficiencies. You just pay the deficiency plus interest, a little bit of a loan. You didn't think it was a loan at the time, and now you found out it's a loan. Fine, you got to pay it back. Penalties are for misbehavior. There's undervaluation penalties, overvaluation penalties, leaving out part of your tax. My book is telling you, here's what the penalty, it lists all the penalties and how they're triggered by a real estate investor. And it says, don't do this. Don't do this. You get into like the valuation of the building versus the land. If you overstate the building value, you could be charged with a penalty for overstating that percentage of value. But I discuss at great length you're supposed to have a reasonable basis and yada, yada, yada for each different penalty. There's this specific wording in the law, and I cover all that stuff. What this book will not do, it's not going to tell you to start your own church. That would work because it's a nonprofit, but it's not in the book. That's not how I'm going to tell you to avoid taxes. It's not going to tell you to put everything in a family trust. They're dubious, and I don't do that kind of stuff. It's not going to tell you that income taxes are unconstitutional. You can ask Wesley Snipes about that. I think he's out of jail now. He said they were unconstitutional. It's not going to suggest you become a tax protester.
They amended the Constitution. They're quite constitutional.
The 16th Amendment and numerous court decisions have upheld it. It's not going to tell you to cheat. I can't believe all the real estate books that tell you to lie on a mortgage application. It's a freaking felony. 18 U.S. Code section 1001, 1012, 1014. Don't do that. It says not going to tell you how to write off vacations in Hawaii. We already covered that. Mr. Kiyosaki, the best-selling financial book of all time, Rich Dad, Poor Dad, Pack of Lies. And I said so in print on the internet, and Mr. Kiyosaki said nothing about it. So yeah, you got to know the law. For once in your life, know the tax law, and then you can look at what your CPA is doing, and you may find, as Lee Robinson did, he wrote the book Landlording. He read my first edition, and he had a CPA all those years. He's one of those guys, well, I don't worry about that. I don't bother my pretty little head about taxes. I have a CPA. So he read my book. He looked at the tax return for the last year, and he fired his CPA. And I have a million stories. People tell me, I read your book, and I fired my CPA. So you need to do that exercise. You read the book, then you look at your tax return, and you call the guy or girl in. What in the hell is the reason why you didn't do, this book says you should have done such and such? Well, you said you didn't want to be audited. Yeah, don't ever tell your guy you don't want to be audited. You 0.2%. Okay. So just, you get audited, no big deal. I have a thing called Reed's Rules for Understanding Income Taxes. This was reprinted in the Wall Street Journal. Really, I think it might have been front page. It was so long ago, I'm not sure. Rule number 1, income is good. Now, why do I need to tell you this? Because I heard a guy on the radio once if he answered a question, he won $1,000, and he answered it. And he said, I don't want the $1,000, so put me in a higher tax bracket. Give me a freaking break.
Jesus.
That's not how it works. It's a marginal tax bracket. It's like a big layer cake. And on each layer, you pay the rate for that layer. And when you go up into a higher bracket, you'll only pay that rate on the increment that pushed you over, the amount by which you exceeded. So the only way you would ever turn down income is if the tax on the additional amount was over 100%, which occasionally is. Now, my brother-in-law died in Massachusetts in 2016. There, when you go over, I think it was $1 million. If the estate is over $1 million, that pushes the bracket up on the whole estate all the way back to the first dollar. So, but not in the Internal Revenue Code. So income is good. Okay. Try to stay with me here on these difficult rules.
Income is good.
Yeah.
It's easy to remember.
Rule number 2, some kinds of income are better than others. And that's nowadays they have the passive loss limits. So passive income is good because you can deduct passive losses from it, but you can't deduct passive losses from other kinds of income. So some kinds of income are better than others. Rule number 3. Now pay close attention. Hold on to your chair for this one. Losing money is not good. Now, people are constantly saying things. They think, well, the losses are no problem because I can deduct them. What? That just makes them a little bit of a discount. Your after-tax loss is less than your before-tax loss, but it's still a loss. It's not good. You don't want a loss. Rule number 4, depreciation is mostly good. This actually is a little nuanced. If you buy a car and you depreciate, the actual depreciation in the Blue Book, Kelly Blue Book, is similar to what you're deducting. On a house, piece of real estate, the building value is not really going down as much as you're depreciating on your taxes because the studs, the foundation, the exterior wall, they just sit there forever. They don't depreciate. Now the roof depreciates. Okay. If you got asphalt pavement on your driveway, it deteriorates, it depreciates, it will have to be replaced. All the refrigerators and stuff in the house are going to stop working, going to have to be replaced. So depreciation in real estate is in part a BS number that you're applying to things like studs and foundation and all that are not really declining in value. Matter of fact, they're going up in value. So that's a good deal. But the fact that you're depreciating the roof is not a good deal because the roof is falling apart. Now, my house is slate, so it's not. But on an asphalt shingle roof, it's going down in value. And so is the asphalt parking lot, the refrigerator, and all that. So depreciation is not some kind of con. It is partly a BS deduction. And the problem is you depreciate it, but then when you sell it, your gain is calculated on the sale price minus the adjusted basis, which means what you paid for the building minus all the depreciation you claimed. Furthermore, that depreciation is taxed at 28%, whereas the capital gain would be taxed at probably 15 or 20. So it's not, you're not putting something over on the government to claim depreciation. Rule number 5, deductible expenditures are bad. The fact that you can deduct it just means the after-tax cost is a little bit less than the before tax. And in real estate investment nowadays, because of the passive loss limits, which came about in when Reagan signed the Tax Reform Act of '86, you can't deduct your expenses. They just sit there. They're called suspended. So they sit there until you, quote, dispose of all interest in the property, end quote. So a lot of these deductions that people think are such a good deal for real estate investors, you can't deduct them when you have them. You have to wait until you get rid of the property to deduct them. Rule number 6, don't buy something just because you can deduct it or claim a tax credit. Rule number 7, do take deductibility and rehab tax credits into account. They're about the only ones that apply in order to arrive at the after-tax cost when you are considering acquisition, purchase, or rehab. Rule number 8, don't sell an investment property unless the tax due on the sale is less than $2,000. Exchange instead. It's tax-free exchange. And that's what I've always done with my investment properties. I get rid of all the big ones in '92, but I have another one now. But we carried we exchanged instead of selling, and that way we were able to avoid paying any taxes at that time. When I got rid of them all, then I did pay the taxes. Rule number 9, the only thing worse than a deductible expenditure is a non-deductible one. It would be like amortization on the mortgage. You don't get to deduct that. You pay out $30,000 and maybe 25,000 is interest. The other 5,000 is principal. It's gone. It was an expenditure. It's out of your bank account, but you can't deduct it. Now it does when you sell the property. The amount of the loan you have to pay off is small, so you ultimately get the benefit of it. Number 10 is better to deduct than depreciate. If you're not stopped by the passive loss limits, deducting is this year. Depreciating spreads it out over 20, 30 years. And rule number 11, the final rule, when you can't deduct it, try to depreciate it. And if you can't depreciate it, try to add it to your basis, which will reduce your capital gain in the future. So those are the Reed's rules. Dan, you wanted a few minutes for questions. Do you have any?
Oh, just as we were going through, listening to what you had to say. Not really. No, I mean, are there other lists in the book other than what you just gave off?
Oh yeah. It's thick.
Yeah.
I want to get hit over the head with it.
Yeah, a lot of info in there.
This is a comb-bound version, by the way. So this thing is called a comb. That's what I ship you now. On April 15th, I'm supposed to get an 18-wheeler, pull up in front of my house, paperback versions of this, if it matters to you. They have the same content. This can be laid flat, and it won't come back up like a paperback. You can also do this with it, turn it into a clipboard. This costs me more to make than the paperback. Some people think this is cheap. No, it's more expensive. So anyway, this is what you get if you order now. You get a paperback if you order around April 15th. And don't give me a hard time about that date. The Congress of the United States waited till December 17th to pass this new law, and we had to read it. Not my fault.
Getting out as fast as you
Plus. This is the 20th edition. The 19th edition actually covers the 28 your taxes for 2017, which is what you're now working on. So the Trump laws generally take effect starting in January 1st, 2018. So do we have any questions here?
No, just some thank yous and stuff like that. The book's not arriving until April 15th, or the paperback version.
This one's here.
Is it easy for people to delay the April 15th deadline?
Yes, it is.
The impression it is.
Yes, it is. There's an automatic form you can file. Now, you have to pay the tax on April 15th. But there's a form you can file. I think it gives you an automatic extension to October 15th or something.
Just to file the return.
To file a completed return.
You got to make some.
You got to pay.
You got to make some estimate of what you owe.
If your estimate is low, you pay interest on the difference.
Right.
But yeah, there's an automatic thing you can do. But
so they could order the book and they'd have time to use it for this year, if they do that.
Well, if I send them a comb bound, they will. Right. But anyway, if you have last year's edition of my book, that covers the 2017 taxes, which is what you'll be doing on April 17th. So this book also covers the 2017 taxes. And then it says effective 1/1/18, yada, 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 all the 20% discount on business income. And I added a chapter of this book, by the way, on personal residence. I always had the attitude that wasn't a real estate investment. I was dead wrong about that. Plus, most of the tax reform, or the Trump Tax Act, had to do with a lot of it had to do with personal residence stuff, like the standard deduction, home mortgage interest, and property taxes and all that. So I added a chapter on personal residence to take into account the importance of all that. So let me tell you the nature of tax benefits. I touched on it before. One is in real estate, you want to invoke all the rules you can that apply to you. And I'm not talking about maybe they apply to you as questionable as judge. There's no judgmental. Home office, you can do it. And a whole lot of others, credit for prior year MT, these are clear cut. You want to know what all those are and make sure you take advantage of all of them. The second thing is you want to delay paying whenever you can. And either because of time value of money, interest in, being able to put the money in real estate in the interim, or maybe you'll be in a lower bracket out in the future when you have to pay the tax. So those are, there's no great mystery to real estate tax benefits. Now the Internal Revenue Code is quite complicated, and a lot of the benefits are quite obscure. One of them, for example, is I had my kids working, Dan and his brother Steve and Mike. I had them working for me when they were under 18. You don't have to pay Social Security on a person who's in your family and under 18 and working for you. There's very few people know about that. You don't have to pay Social Security.
Child labor.
You don't have to pay Social Security on rent income. It goes on Schedule E, rent and royalty income. You don't have to pay Social Security on that. So there's all kind of little obscure things out there that a lot of people don't know about. The Tax Reform Act of the Trump Tax Act. Let me do. My son wants to hold this to a half hour today. The Trump Tax Act. What's that?
Keep going.
The Trump Tax Act was talked about a lot. I swear. It was talked about a lot, and there were a bunch of things that were not enacted. And I wrote down the page number incorrectly, so now I can't find it. But anyway, one of the things they talked about was changing the number of months or years you had to live in your house in order to claim the $250,000 per spouse exclusion on the capital gain. That went away. I will have to defer that to another time. I wrote the wrong page number down on the stuff that was not enacted. But they talked about a number of things that they talked about them so much that people think they're in the law. They're not. And there's a list of them in the book. Any questions? Questions from the peanut gallery? I'm looking on the screen here to read them.
Yeah, no, just some basic stuff. So I think that's it.
All right. Thank you. See you next time.
Thanks. We had one viewer on YouTube.
Is it already up on YouTube?
I think he can still hear us.